Disney reported earnings last week and the stock jumped by 7%. At the current share price, the company has a market value of $164 billion, with $17 billion of cash and investments and $46 billion of long-term debt. The enterprise value is $194 billion. Disney revenue over the last 12 months is $89 billion, with $8 billion of adjusted net income and $5 billion of free cash flow. Based on those figures, Disney stock is valued at just over 2 times revenue, 24 times earnings and 40 times free cash flow. That doesn't sound particularly cheap, but there's one thing to bear in mind. Disney's streaming business is still growing and not yet turning a profit. When streaming turns profitable, that will eventually provide a boost to Disney's future earnings. And with $22 billion of streaming revenue this year, that boost could be significant. Assume a 3 times multiple to that $22 billion of revenue and you get $66 billion, which would take Disney's enterprise value down to just $128 billion. In other words, taking into account future profits from streaming, Disney is potentially valued at only 8 times EBITDA, which is extremely cheap for a company like Disney. Netflix, by comparison, is valued at 6 times revenue, not 3. However, there's a catch because Disney's other segments are also coming under significant pressure. Almost 40% of Disney profit comes from its cable and broadcast networks. These networks are declining rapidly as more and more people cut the cord and turn to streaming. Meanwhile, roughly half of profits come from Disney parks, which are liable to an economic downturn. A single-day ticket to Florida's Disney World with add-ons can cost well over $200, meaning Disney will find it hard to juice profits much further. That said, returning CEO Bob Iger is making some big moves. The company is targeting $7.5 billion of cost cuts, which is helping to improve profits across its media platforms. And in August, Disney announced a $2 billion deal with Penn Entertainment to launch a betting platform called ESPN Bet. It's an abrupt change. Just 4 years ago, Iger said,
"I don't see the Walt Disney Company, certainly in the near term, getting involved in the business of gambling and facilitating gambling in any way."
In fact, Disney spent $20 million in 2018 lobbying to make it harder to build casinos in Florida. But hard times require hard measures, and Bob Iger clearly has his hands full. With its brand and history, Disney will most likely have a higher stock price 10 years from now, but that doesn't mean it's going to be a smooth ride for investors. For that reason, I give this stock a neutral rating, but these are my personal opinions, not financial advice, and I've got no position in Disney stock. For more videos like this, make sure to visit my website 3minutebreakdowns.com, and thank you for watching.